Okay, so last time we talked about many things, especially about valuation. So yeah, here we have everything about the value of my suboptimal case study, and also definitely we have the even more suboptimal original company, which is, yeah, we can say that even when I was changing stuff randomly and just saying that, okay, by adding a new, completely untested, we can say untested engine because it was running some minutes for brake pad, but still we are far from vehicle integration, so usually the exploded stuff is waiting for us. But still I was putting this sketchy thing together, and at the end of the day...
Hans will come. He told me like something happened on the way, but he is here in 5 minutes.
Okay, it's good. Hi. Yeah, so now we should write the report about this. So this should be, or supposed to be, assignment 2. So what is your company's fundamental value? What is the fundamental value of your shares? And in this case, it's better to start that what are the underlying key variables. So when you have to do the exam, during the exam period, obviously one of my favorite questions are the DCC. The DCC valuation, and in this case we just have to follow through everything. So obviously the first step is the free cash flow. What happens with that? Then also we have to check what happens with the weighted average cost of capital. We need it definitely because after that, during the next classes, we will test or we will at least try to optimize the capital structure of the company, and that's why we need at least one baseline value where we can see that, okay, without mingling with this stuff, then what is the weighted average cost of capital, and can we make it better or not, or maybe we can do it better, just we are increasing risks. So that's why we have to consider that one soon. Also we have to check salvage value, so assets after 5 years, so salvage value. Even if the endeavor is not so successful, then still we can and we have to sell the assets, and also we have to be really happy for any kind of cash reserves what we were able to accumulate during the 5 years if something remained. But okay, we are optimistic, and then at the end of the day we can see that, okay, discounted cash flows and corporate value. And after that, value of equity. So these are the steps for today, and if we can progress further, then we are also, at least I'm also happy. Okay, let's make some beautiful numbering. Formatting is always crucial. And then free cash flow. So what is happening here? We did it hopefully nicely, because it was I can say long time ago, but yeah. So last week, 3 weeks ago. Yeah, that was long. So maybe it's easier if I'm just picking up past values. Yeah, okay, so this is the free cash flow. Just I would like to make some nice graphs and free cash flow, and we can say original. Also, what we need to meet my structural requirements, weighted average cost of capital. So also from the original case study, we can pick up watts, VACC. This is the... Okay, I was copying in the wrong place. Okay, so, and then we need discounted cash flow and the salvage value. No recovery, to recovery, and DCF. This stuff, and also value of company and cash value. Cash value, sorry, equity value, euros. And now we can make the doing the same typo twice. Writing everywhere that this is the original, so yep. And now we just have to say that, okay, beautiful new cash flows, old cash flows. We can see that, oh, now the line is increasing, which is nice. Obviously, this is not in bread, so we have to add that this is in million. Oh, also, we can add the numbers, and also we can add that million euros. Okay, and also years. Since it's already written there that free cash flow, I don't care about giving even a title. Then next stuff. Well, it's so nice that sometimes it does want to highlight the content, sometimes it doesn't. So, okay, let's change it to weighted average cost of capital, weighted average cost of capital here and there. And then we just have to do the same thing with the VACC. And also, yeah. No, cancel. Everybody will be a number. So some formatting must be done. Everybody is a number except you, because you are percentage. Maybe 1 digit is allowed, but otherwise not. Okay, and that one is disgusting, so I will remove it. Then the next thing is the DCF. Hi. Okay, for the salvage values, it's just easier to say that let's create bar diagrams. So discount the value of relevant assets in the 5th year, that's the salvage value. And then we have to see that what is the value of the company. And right now the equity itself. Still D plus C, so debt with equity altogether. But also you are okay, based on this, then we can write the report. About free cash flow, about the cost of capital, sorry. Let's remove this one and let's just keep the corporate value here, because after that we will play a lot with the capital structure, so it would be a bit misleading. Yeah, so first of all, we can see that after consolidation, after the change of the business model and the key product, after the 3rd year, we are in a growing phase. First through year of research and development and live testing, or we can say iterative testing, iterative development. So when people are testing in live, or cash flows, will start to grow. Can we say this is not an exponential growth yet? So we can say that this is growing by a linear trend line. It's not ramping up completely. It's not a sudden scale up, just moving from this horizontal line towards some kind of a growth. So it's start to grow by a linear trend line. Which is nice. Then, as we did not change the capital structure yet, the VACC is the same. The company is mainly funded through equity, or only funded through equity. And however, so this is the point when we have to start to think about survivability. So maybe you will do it better, but my first year of having only 3 million euros as an annual profit, that one is a bit weak, or I can say sketchy, but it's stretched out definitely. So the company is not robust. So if we are suffering from an accident on the launch pad, during launch, after launch, so something wrong is happening, which should, and is highly probable, because okay, we can see that revenue generation is highly probable, but landing is not. So there will be some kind of a mishap. Then in this case, we are forced to run this 1 month, 2 months long investigations, as usually happens in the industry. And in this case, we can easily go back behind schedule. And also at the same time, our cash reserves are really, really weak. So mostly it's existing because the depreciation is diverted there. And that's why we can save some cash because of this artificial expenditure. So, so the company requires a fund. So this setup, at least, at this setup, the company needs additional sources. To maintain its robustness against external and internal shocks. For example, mishaps, investigations, delays. Mostly nowadays delays are happening not because of the launch provider's mistake, but mostly from delays at satellite manufacturing. So in past, so 10 years ago, the bottleneck was always in the launch business. Nowadays the bottleneck is in satellite manufacturing, because everybody launches constellations nowadays, not just one satellite. So it means that they have to mass produce them, and that's why still there is a small set of satellite manufacturer. The market is bigger than the launch business, but still they moved a lot towards mass production. They moved towards from using unique components. Nowadays they are putting together off-the-shelf, practically retail level hardware. So like in the space station nowadays, they are not using specialized computers. They are using just laptops, iPads, and so on. So it's finally we can say that this era is over when they need space stuff in space. Now just maybe they are using 3 or triple processors, or they are just making stuff robust. Instead of using 1 computer, they are using 3, and then if 2 of them are not agreeing, then they are checking the result from the 3rd one, and that's all. So they don't need any kind of special hardware. But still, if there is any kind of a delay, then we need financial runway. We shall or should require some additional funding to maintain a healthy financial runway. Yep. So in this case, we can say that, okay, but what should be the financial runway? So at least let's check that what kind of expenditures do we have. So at least we should cover manufacturing, wages. We don't care about depreciation. So this one is already 180. So let's say that since interest rates are so low nowadays, then we need 200 million euros. We don't have that, so at least to cover and people would say that I'm not conservative enough, so in real life I wouldn't ask only for financial runway to go over the first year, but yeah. So at least to cover the relevant expenditure in the first year, we need million euro as an additional, or yeah, as an additional investment. During assignment 3, we will consider the current alternatives. Yeah, so this is what we should remember, that okay, this is not the final setup for the capital structure at all. Then discounted value of relevant assets in the 5th year, then we can see that due to elevated cash revenues and their accumulation in our balance sheet. So we are not just realizing more cash and then paying out as dividend, but also we are investing into the company. So that's why it's accumulating in our balance sheet. The salvage value will be bigger. Also, as the salvage value is significantly larger, than the debt. So this one is several billion euros. The debt is actually it's 2 million euros, or if we are increasing, then it will be still 200 million and 2 euros. So it's significantly bigger. That it can cover. It can be used. Sorry, not it, because it's not well defined. So salvage or assets, marketable assets, sorry. So everything which has a secondary market and we can sell it can be used as a collateral for that. Obviously, this collateralization can happen only in the case of a bank loan. So future. If you would think about collateralized bond, then usually not an asset, usually some kind of a cash flow or some kind of other bond or security should be the collateral for a case like that one. So yeah, we don't want to combine them in this way, so only for bank loan. But still we can say that, okay, we can do it. Then discounted cash flows. Following a steep linear growth line. After the implementation of the new product. It would be much nicer if this would be exponential. So it would mean that our customer base is exploding and so on. But right now we are happy if we are just growing somewhere, not struggling to exist. So it's a good news. Just if it would be in the IT sector, if we would be working on the global market, on the internet, then we could have this exponential growth opportunity. Right now it's okay, still better than nothing. Then value of the company is increasing by a lot. So value company will be by, let's give some percentages. People like percentage. Oh, I already created some of this here. Okay. So, sorry, new value. New value minus old value divided by old value, and then we can, it's 1, nope. $147%, which is nice. If the market accepts the feasibility of the new strategy. In this case, the problem is that if we are announcing the strategy way too earlier, so as a venture capital firm, we have to purchase the company at first, or at least a significant share package must be purchased at first, and then we have to announce this strategy, because otherwise, if they are thinking or assuming that, okay, this can be done, then the share prices will, or should, or supposed to grow immediately. and that's why we can lose some of our profit in this whole procedure. But at the end of the day, if we can close this down with a profit, then the problem is that, so this is potential for today. If we can say that expectations about the future are valid, but if we are closing down this position in the 5th year after implementing it, the problem will be that the value of the company will depend on the assumptions about the next 5 years. So from the 6th year until the 10th year, where right now we don't have any kind of a business plan. So this is the risky part. That right now we can consolidate stuff, we can build this thing up, share prices will jump eventually, but still we cannot say that, okay, what happens 5 years later, because if we after that, if we are just stuck at that current level and we cannot grow further, then even share prices can decrease, because now this growth story will be removed from the share price. Yep. Okay, now the next thing. First of all, let's save it. The next thing is distress analysis. And yes, that one is completely missing, so we have to build this one up, unfortunately. So, and in this case, to build this thing up, we have to pick up our beautiful lecture notes. Maybe in this case I will cheating and I'm copying it from the document version, not from the PDF version, because slightly easier. Okay, so we could do the Altmanzi, but that one is boring. I don't want to do that one. So we should do the Ohlson-O scoring, because that one is interesting, and this is where we can get a probability of default. So actually we can get a p value, not just some random numbers within a range which were calibrated in the 70s. So yeah, this one is much more suitable for our purposes. So if we have to do this, then we just have to follow the steps. So first of all, we have to copy. It's more reliable and it's harder to mess up if we just identifying the key variables, copying them into the Excel, calculating them, then multiplying with their coefficients, and after that we just add them together, and in this case it's harder to create mistakes. Yeah. So let's zoom in, because in this case you can see it, what I'm doing here. And now I just have to copy the coefficient. Let's make some nice description. So this is O, probability of default. Let's use bold, because this is a bold move. And also I have to add the constant. So this is the coefficient. These are the variables. And this is the variables values. So we should follow some kind of a structure like this. And let's use italics. For the constant, the value is 1, so that one is simple. First, let's build this one up. And then we can see what to do. We should not forget that if something is negative, then we should keep it as negative. at least some of the variables will be zeroed out. It will be easy to deal with them. So this x and epsilon, if I remember well, then they should not be considered at all. Yep. So now we have the necessary equations. Then the next step, what do we need here is the GNP of France. It's really nice because during the last decades we don't have GNP. So France gross national product. Oh, sorry, it was GNI originally. Just yeah, they discontinued this statistics since it was published, and now we can see that okay, this is the most recent value. This is in billions, in US dollars. Okay, we should convert it down, but yeah, so okay, so now decimal point is in the right place. Then that was in billions, we need millions, so I should multiply it with 1000, and also I should convert it to euros. So okay, without the multiplication it could be done easier. Thank you very much. So now this is okay, let's add decimals because this looks ugly. Okay, so this is the GNP of France. So now we can say that okay, logarithm of the total assets divided by the GNP. And also, oh, nearly forgot. We have to add the business year. So first year, second year, and so on, because in this case we can see the development of all this stuff. But okay, the GNP will be the same. I don't care about growth of the economy. For me, what is relevant that this variable defines a too big to fail criteria. So if the company is bigger and more relevant from the GDP, even if we are defaulting, then there will be a government bailout, or at least we can hope for one. And also we can say that yeah, if we are already stretching these things out, then maybe let's multiply it also with the coefficient. So you are multiplying them, just I'm fixing also with the dollar mark, and then tap, 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 tap. Now it's nice. Not negative, it was already negative. Just checking. Okay, it was negative already. Then total liabilities divided by total assets. So debt plus current liabilities. I don't care about this non-transparent thingy because I have no idea what is there, and in this case we should ignore them. Okay, in case of this is total asset. Okay, that one is transparent. So. Yep. Also, in this case, we have to fix only the coefficient, and the rest will be dynamic, and it rolls through from years to years. Total liabilities to total asset. This is the leverage situation in the company. So obviously, if this thing is shrinking, then it means that we are funding more and more stuff from equity, which can be fresh equity from the owners, or it can be retained earnings. So practically we are more and more profitable. So this is the healthy way, but we can see that this is gradually declining. And also this is highly valued by the coefficient. We can see that it has a positive contribution, so it's against our probability of default. Then we had already working capital, floating capital. This is what we had only, but yeah. If this would be a real proper company, then we would have cash flow reports, and in this case we would have proper working capital value as well, but right now we don't have. So floating capital divided by total assets and fixing again the just let's check this one. If I'm doing anything wrong, but I remember that subtracting current liabilities from current assets. Yeah, this is okay. What we have here, good. Then we have to look for the short-term exposure, so current liabilities divided by current asset, only the transparent ones are considered. I should fix you, and then t. Now, what is this X? X is 1 if total liabilities are bigger than total assets. Okay, so if what? Total liabilities. U plus U. Okay, I should open another secondary bracket. Are bigger than total assets. Then you are 1, otherwise 0. And then we have to multiply all this stuff with this number. And let's fix it. And then we can see that, okay, this. Okay, total liabilities, total assets. So when we are running at negative equity, this is a disastrous scenario, so obviously we don't want to have this. Okay, next one. Net income. Yeah. This is what I hate in English expressions, because it's it's not the income. So it's not it's in conflict in my head with always with the concept of income. This is not income. This is profit, net profit. Not income is like revenue. It's not that one. So net profit is much better. Net earnings, it's also a terrible phrase for that. Net profit, yeah, this is the proper stuff. So income from costs, income minus cost of goods sold, expenses, depreciation, amortization, interest, taxes, and so on. So practically profit after taxation. Why don't they can just use this phrase, profit after tax? And the total assets, okay, then you. And that's all. I have to fix this one. Roll through. Practically this one measures that how profitable the company is, and not just that one, but if we are accumulating a lot of assets, can we use it to generate any kind of a profit? So that's the big question here. Okay, funds from operations, so you multiplied by, right now we have only floating capital, so not much. Again, we can check. Close. Net income plus depreciation minus gain on sale net. Yeah. Okay, this is highly special stuff. Okay, we can. Then not you. So net income plus depreciation. We don't have the third component. And then divided by, okay, we have this sketchy total liabilities, so current plus debt, and that's all. And then we have to fix the first component again. Then tim. And then we have arrived to epsilon. If the net loss of the last 2 years, if there is a net loss in the last 2 years and zero otherwise, we are not in losses. We can make also a function for that, so first of all, let's start with the if function. If okay, not from the 2 years because I don't have backwards data, so let's say that in the current year, if we are in losses, then 1, otherwise 0, and then we have to multiply this number with that one. And also we have to fix this. Oh, this is the beauty. So net income from the last several years. Okay, let's build it here in the second year, and after that I will alter it more. So net income. In this case it's simple because we just have to say that, oh, u minus u okay, it was correcting something and I was not looking on it, but let's assume that. Then we have the absolute value of the same stuff. And also we should use the dollar mark. And you can ask the question that what should we do here? Then okay, let's move it backwards. Then obviously we don't have value for the first, for this component here. In this case, I can say that somehow we need data, and in this case the somehow we need data will be solved by just picking up this value. So the original without any changes. $67.9. So the first year my number will be negative because due to my new business plan my profitability drops in the first year, but after that it will start recovering. And you can see that this one is highly linear. Sorry, it's a constant, but because this measures the steepness, so the delta of the change of the net income, and surprise, it's quite gradual, so it should be not that gradual, but I can't see any mistake in this one, so it looks nice. Okay, so now we have the Ohlson-O. Let's check that did I miss anything, because it can happen. No. And now we have to calculate the Ohlson score. This is still just the O value. And in this case, we just have to sum up the entire column. Right now, we cannot see much from it, but after that, probability of default will be that now we have to use also this equation here. So, exp U oh, you don't know what is exp. What is exp in Hungarian? Then doesn't matter, we have to use the Euler number. Euler's number is this. I cannot copy from here. Yes, I can copy from here. Yep. Decimal comma. So E on the power of O is divided by 1 plus this number. Let's check it's 1 plus or 1 minus. I'm always forgetting. Okay, 1 plus. And then this is decreasing and this is percentage. So we can see that after this careful management and technological decisions that we reform the whole product structure of the company, now the probability of default is shrinking from close to 100 to 15%, which is good. Or at least the Ohlson-O scoring is not contains much bugs. And it's really good because now we have two metrics. So one metric reflects on increase of the expected value of the shares, And the next one is about the probability of default. So at least we have some robust assumptions. So not just one, or we can backtest that, okay, if they are in conflict in each other, then one of them has or should have issues. But now we can see that, okay, this one is good. Now we just have to copy the whole stuff into the other Excel sheet. So I have to make the same thing, just faster. Copying you. And yeah, I just have to copy this one. Control F. And I just deleted the reference to the other Excel sheet. And now it reflects hopefully in the same stuff. We can see that, yeah, the original probability of default was high and still high. So this is why I was mentioning that the state of the company, even if it's profitable yet, it's quite dubious. So again, we can solve this problem, just copy, paste, and then just highlight from the formula that, okay, we don't need the reference to this other Excel sheet's name, and then if you are deleting it, then you can use it original. So this is the value added part of our job. This is the Ohlson-O method. Probability of default, original, and the new one. In case of implementation of the strategy, of defaulting, a probability of the bankruptcy will decrease significantly. In this case, we are not just... So maybe you can say that, yes, the method is relatively old, it was calibrated on other sample, but practically what matters for us that we are far from 100. So in this case, the confidence interval can be that, oh my god, maybe we are not at 16%, we are at 20-something%. Doesn't matter, we are closer to 0. So not at 100%. Will decrease significantly, but it highlights grave danger. So high exposures towards internal and external shocks in the first 2 years. So again, this is also reasoning why we need some kind of a cash buffer. So it's not enough just to say that, oh, my company is profitable in the first year already, so I don't need any excess cash. But if anything is messed up, then we'll go down a lot. So, and even the second year when we became profitable, still we can see that yes, but this is still risky. So after that third year, okay, perfect. So maybe I was quite aggressive with by setting the necessary cash or funding necessity only as 200, because in the second year we need a lot of money. I mean, we have a lot of expenditures. Hopefully we have also a lot of revenues. Just, yeah, it's this one is. So this in the second year, if we are making any mistakes, then we can suffer way more, because in the first year we are conservative, we have only 4 launches, so one explodes, doesn't matter. But if there is any stand down in the second year where we should have to do 20 launches, so every second week, practically, or third week, one launch, then we are facing lots of troubles. So we have to maintain the manufacturing, we have to maintain the people, but in this case we can lose a lot of revenues. So this 2 million is quite narrow. Okay, we don't need this. Okay, and obviously we need some kind of a conclusion here. The new strategy will improve the value of the company. So it has a contribution. However, this growth is not exponential. And we are only catching up to the market leader. So the problem is that, okay, right now we are doing what was sold by SpaceX 8 years ago. And we will be really happy that, oh, we were able to do the same thing. Just the problem is that right now, Starship, they already retired the second version or second block of Starship, Block 2, which was exploding a lot during the first half of the year, but the last 2 tests were completely fine. Even last week at Flight 11, nothing was exploding during flight, because last time some valves were exploding. They were not that relevant or not that necessary for the rest of the flight. Just, yeah, they went kaboom, and also some part of the flaps, some aerodynamic stuff were burning up when they were coming back into the atmosphere with the second stage. But just the problem is that once this platform becomes reliable, they will not just reduce launch numbers by $100 million by halving the expenditures. In this case, they will cut down costs of launch by a digit, or maybe even more, if they became more and more reliable and frequent. So this is a big danger, that maybe we are improving ourselves and became reliable after 5 years. Just after 5 years, we will be operating on a market which moved forward again. And we have to develop a new product as well. But yeah, this is life. So, however, this growth is not exponential, and we are only catching up to the market leader. Which exposes us. to their ability to grow. Yes. So Peter Beck had an interview last year, and he had this impression that European space business is finally developing. Just the problem is that they are trying to solve problems which happened or which were relevant in the last decade. So somehow they are 10 years behind everything. And yeah, this is what I'm also doing. That, oh, we should solve this one. And yeah. Okay, which exposes us to their ability to grow. Okay, also Peter Beck was also lagging behind because right now they are trying to build their own version of Starship. Just at least they have now an engine and parts of the vehicle already. But on live camera, he was eating his hat several years ago when he was announcing that even when he was convinced that he never wants to build giant rockets, only small ones, now he realized that they can't scale up their operation. So they stuck again with this linear growth, that they can have way more launches than the rest of the market. Just this is absolutely not enough to cover the demand. Yeah. Which is what has to their ability to grow. And we can lag behind again if the fast recovery of the second stage is solved by someone. Yes. Yeah. So these are the risks for us, and also the company. We identified risks in the first 2 years. Therefore, it is necessary to create additional capital buffers to raise at least €200 million financial runway. Maybe we need this, maybe we don't need this, but as at a later part or during the next seminar, I start to analyze that, okay, if we are using funding through equity, if we are using funding through bonds, if we are using funding through financial lease, and so on. So what are the options? In this case, for me, it will be easier because I can say that, okay, if we are using this additional capital, then how the company profitability and probability of default will react on this. Yeah. Okay, so further questions to answer. Funding. Okay, we define the funding needs, but the funding ways. Equity, bonds, financial lease, sensitivity towards funding costs and exchange rate. Yes, this is still. We have to answer it. Impact on value and probability of default should be explored further. We did this, so we don't have to do this anymore. yeah, so this is assignment 2 sample with all this beautiful stuff. And I'm also saving the 2 Excel sheets, because if you are just modifying it, you are adding your own numbers, then it will be recalculated perfectly in a fine manner, and then you can just use it for your own purposes.